Hello everyone. Why do so many investors lose money in the stock market? The most painful thing in life is not just losing money, but actually losing everything. What does it mean to lose everything? During the 2008 financial crisis, I witnessed almost everyone who invested in stocks appear on television and in the press with miserable faces. Some people even contemplated suicide when stocks plummeted across the board. Whatever you bought, you lost money. At that time, people were grappling with two main questions. 1. Should I sell my stocks now? 2. If I don't sell, will the losses get even worse? Why did it feel like their money was evaporating like steam, disappearing without a trace? And then, they blamed the government. Economists argued that policies couldn't save the economy. This contributes to why so many investors lose money in the stock market. They lose money but often don't know who took it. And then they cast blame. They might turn to technical analysis, which some see as just an art of blaming bad luck. The stock market is often presented as a zero-sum game. If you lose money today, someone else definitely made money, much like gambling. If 10 people each bring $100 to a casino, even if one person wins everything from the others, the maximum they can win is $900, because that's the total amount the other players brought. The question is, when a financial crisis hits and it seems like everyone is losing, who actually took the money? I once read a survey showing that in the US stock market, the average loss per investor during certain periods was about $10 to $20. The important takeaway isn't the specific number, but this: if you invest in the stock market and manage to lose less than this average, it statistically means you're doing better than most investors. The long-term reality of the market often seems to be that most of the money doesn't end up in the pockets of the majority, but flows into the hands of a very small group of powerful players. They can be divided into 6 groups, and today I will reveal them, potentially offending some powerful figures. I hope you'll support me with a like so this video doesn't get taken down. The first group is brokerage firms and banks. Why are you encouraged to learn about stocks when you turn 18? Because as long as you make a transaction, profit or loss, brokerage firms charge commissions. If you don't have enough money, they're happy to lend it to you at interest margin. So, this group almost always profits from market activity. The second group is the government. They collect taxes on capital gains and dividends. The third group consists of people with inside information, such as major shareholders of listed companies or certain high-ranking officials. For instance, news emerged that some U.S. officials sold off stocks before the government publicly announced the severity of the pandemic. This was at a time when many people weren't wearing masks and didn't grasp how worrying the situation truly was. The fourth group involves newly listed companies, IPOs. They issue stock, essentially creating value on paper. Some companies might only have modest earnings, say tens of millions, but when they go public, get listed, the paper wealth of the business owners can soar into the billions. Their primary gain often comes from the stock market listing itself, not just the underlying business operations. The fifth group is legendary investors, individuals like Warren Buffett or Ray Dalio, known for unique strategies and trading systems that allow them to profit consistently over the long term. Personally, I identify as a trend investor, which helps me achieve stable profits. I often analyze the actions of the sixth group. The sixth group comprises large investment funds, often called institutional investors or smart money. During market crashes or downturns, when value seems to evaporate, these are often the players accumulating wealth. They quietly enter the market when others panic. The exact amount of money they manage is unknown, but it's estimated to be in the hundreds of billions, possibly trillions. No one knows the precise figures. What is known is that the sheer amount of capital they control gives them the potential to influence, or even manipulate, the entire market. One famous example often cited in this context is George Soros, sometimes referred to as a market hunter. He has been quoted comparing market dynamics to the law of the jungle, suggesting a focus on exploiting weakness. While claims of never failing are likely exaggerated, his successful large-scale trades targeting market vulnerabilities are well documented. Among these 6 powerful groups, the hunters, large funds, are arguably the strongest because they can significantly influence when stocks might skyrocket or plummet. The timing of these major fluctuations often seems known only to these powerful groups in advance. This could be due to tacit coordination, superior in-depth analysis, or internally circulated information. I can only speak vaguely on this point. But one thing seems certain. They often make the most money when the market collapses and fear is rampant. The more small investors participate in panic, the more potential profit there is for them. So, how do these hunters potentially manipulate the market? Why are small investors often compared to grass or leeks, jukai jusai, repeatedly cut down only to grow back for the next harvest? And how can one potentially avoid being harvested or even become part of the more successful groups? If you watch this video to the end, I will risk sharing some insights on that last point. My channel specializes in sharing the mindset needed to get rich, becoming an entrepreneur, an investor, and ultimately, a wealthy person. If you don't want to miss this information, please subscribe for free and turn on notifications. First of all, small investors are often at an information disadvantage. You usually don't know exactly who might be manipulating stock prices behind the scenes. You don't personally know all the industry experts or their true intentions. You often don't know if you're walking into a trap or if there's a larger plan unfolding. Consequently, you can easily fall into psychological traps set by market manipulators or even just by market dynamics themselves. This is akin to a mind control game. Frankly, people with bad intentions can exploit this vulnerability to defraud you of assets. Perhaps even luring victims into dangerous situations, like those reported in places like Cambodia involving investment scams. Have you ever heard of the Blue Whale Challenge? It was described as a dangerous online phenomenon. Participants were allegedly controlled and threatened by organizers, with tasks escalating tragically. Outsiders might think it's ridiculous, believing the participants are simply stupid, but reports suggest those involved often didn't fully grasp what they were part of initially. Nor did they know the alleged final task. The author argues this is analogous to participating in the stock market without fully understanding the potential psychological pitfalls. Small investors often don't realize that, in many ways, this market functions like a casino, driven by emotion as much as logic. They might not understand that for many who continuously bet without a solid strategy or risk management, the likely long-term outcome is losing money. The mechanism of manipulative schemes, like the reported Blue Whale Challenge, can be deceptively simple. Each day, it allegedly gave participants a small task. Later tasks reportedly became increasingly dangerous. These kinds of manipulative processes exploit a critical human weakness. The more you invest, time, emotion, effort, money, the harder it becomes to quit. This is related to the sunk cost fallacy. For example, imagine you're waiting for a bus. You've already been waiting for half an hour. You think, if I leave now, the bus might appear right after, and I'll have wasted these 30 minutes for nothing. This invested time that you can't get back is the sunk cost. The psychological principle makes it hard to cut your losses. Reportedly, in extreme manipulative situations, when a final, drastic step is demanded, participants face a terrible dilemma: follow through or give up. Giving up might feel like rendering all previous efforts meaningless. They might think, I've overcome so many challenges. I've put myself through so much. If I stop now, wasn't it all for nothing? No, I've come this far. I can't turn back. I can't lose now. When you buy stocks today, you invest money, regardless of initial profit or loss. The psychological pressure often pushes you to invest more and more. Why? Because if you invest $1 million and lose $500, you'll desperately want to recover that lost money. You might feel the only way is to invest another $1 million, chasing losses. Conversely, if you invest $1 million and profit $500, you'll likely want to earn even more next time. Driven by greed, you might invest $1 million more, perhaps reinvesting both your initial capital and your profits, increasing your total investment. This cycle is driven by greed and fear. Many scam models, and indeed market bubbles, exploit precisely these emotions. Once you put in that first coin or initial investment, the scammer, or the market's psychological pull, lures you into investing a second time. Then a third. Even if friends try to warn you, you might not listen, not necessarily because you haven't considered the risks, but because you don't dare face the truth of the sunk cost and the possibility that your initial decision was wrong. You don't want to accept that the money already spent might be gone, or that the amazing result you're hoping for might never materialize. To escape that painful reality, you might deceive yourself and sink deeper. From a young age, teachers tell you to study hard to get a stable job, but when you enter the real world, you realize advancement often requires fierce competition. All while you're worried about basic necessities. You find yourself just working from morning till night. Then one day, a crisis like an epidemic hits. People around you lose their jobs. You're lucky to keep yours. But now work isn't just about earning a living, it feels like a constant battle. Perhaps involving office politics or just trying to stay indispensable. You feel stuck in a vicious cycle, hoping not to get fired, trying to hold on until your children grow up. But then what? You still have house and car payments. Even when you reach retirement age, you might not feel financially secure enough to truly stop working or relax. Meanwhile, why can people like us, the channel creators, potentially achieve more freedom? Because we have focused on building income systems, particularly online, where value can be provided and customers can proactively find us. What we do focuses on marketing and value creation, attracting interested people, rather than aggressive direct sales. Now, think back to the analogy. If, right from the start, the game clearly stated the final task was destructive, would anyone join? Of course not. Similarly, when you first entered the stock market, you almost certainly believed you could make money. The hope was positive. That's why the stock market has such a low barrier to entry. Even if you faced criticism or disapproval, as long as you meet the basic requirements, like age 18, you can typically open a trading account and chase the dream of changing your life overnight. Unlike traditional gambling, people might not call you a gambler. They might even praise you as a savvy investor. But, the author argues, its underlying psychological nature isn't so different for many participants. At first, maybe you consider it just a trial, putting in a little money to feel the excitement. The initial intention might be, I'll stop when I've made enough. No one starts out planning to become a compulsive gambler or to lose their savings. Perhaps the implicit promise, or the hope, was to get rich quickly and become a winner. But some people lack self-control or refuse to accept losses. They might start thinking, even winning just a little bit back would be good. Once that thought takes hold, they risk falling into the gambler's black hole. They continue to bet, often increasing their size. But often, the more they bet, the more they lose. The more they lose, the more desperate they become. They can't face the reality that the lost money might be gone forever. They sink deeper into unrealistic hopes and continue betting, chasing losses. Just like that, a negative spiral drags them down a path with seemingly no exit. The gambler's black hole is so dangerous because once you get close, it's easy to get sucked into its vortex. What keeps you stuck isn't just external traps, but often the psychological traps you set for yourself. What truly pulls you down, the author argues, isn't necessarily the market itself, but potential weaknesses within yourself, like the inability to accept loss, succumbing to greed and fear, or the sunk cost fallacy. You need to understand, the money or time you've already spent, the sunk cost, is gone. It shouldn't dictate your current decision. For example, you've waited 30 minutes for the bus. Whether you continue to wait should depend on factors like whether waiting longer will make you late, or if calling a taxi is now a better option, not primarily on the 30 minutes already lost. The same applies to the stock market. Your next investment decision shouldn't be based mainly on how much you've already lost. Instead, ask, can I realistically afford to lose more? Is keeping this money in the market the best use for it right now? Or would using it for something else, like a down payment, paying off high-interest debt, investing in a skill, be more beneficial going forward? These are the relevant questions. But most people struggle to overcome this psychological hurdle. They cling to the money they've already lost. It's like asking why first loves often leave people with lingering feelings or regret. Is the ex-partner really that amazing? Or is it the intensity and emotional investment of that first experience that makes it hard to let go? It's often the feeling and the investment associated with past actions that makes them hard to move on from. This psychological attachment is why, the author suggests, scammers can always find victims. and why the stock market constantly attracts new participants who repeat past mistakes. The slang term, leaks, or chives, ju kai jusai, implies small investors are like crops that get harvested repeatedly by market cycles and smarter players. The experts just need to wait for a new crop of inexperienced investors to grow. They might take advantage of major economic events, like the pandemic or cycles of interest rate hikes, to trigger market downturns and harvest profits from the resulting panic selling. How do the experts at the top potentially use their huge capital to manipulate the market and profit from small investors? First, where does their massive capital come from? There are many sources. It can come from insurance funds, massive investment funds like hedge funds, mutual funds, sovereign wealth funds, bank proprietary trading desks, or even pension funds. They control hundreds of billions, possibly trillions, of dollars, enough capital to significantly influence the market, potentially absorbing large quantities of stock or other assets. The next question: how are stock prices determined? Basic economics points to the law of supply and demand. When demand, many people wanting to buy, exceeds supply, limited shares available for sale at a certain price, the price tends to rise. Conversely, if supply, many people wanting to sell, exceeds demand, few buyers at that price, the price tends to fall. How is supply and demand assessed in the market? We look at buy orders and sell orders in the order book. Suppose there are only two people interested in a stock. Person A wants to buy at $10, placing a buy order. Person B wants to sell at $10, placing a sell order. They match, and a transaction occurs at $10. Now, consider volume. If person A places a huge buy order, wanting to buy $1 billion worth eventually, but only person B is currently selling one share at $10, that single transaction still happens at $10. The large unfilled buy order remains, signaling strong demand that could push prices up if more sellers don't appear at $10. Now, suppose 10 people want to buy the stock at $10, but only 9 shares are offered for sale at that price. Once those 9 transactions occur, one buyer is left unfilled. If this buyer really wants the stock, they must offer a higher price. Suppose they bid $11, but no one bites. They might raise their bid to $12. Finally, someone holding the stock sees the $12 bid and decides to sell. The transaction happens at $12. This $12 becomes the new, current price, or last traded price. The next person wanting to trade will see $12 as the reference. Buyers, predicting a price increase, are the long side. Sellers, predicting a decrease, are the short side. Price fluctuations depend on whether buying pressure, long, or selling pressure, short, is stronger. This mechanism determines prices for stocks, commodities, gold, oil, cryptocurrencies, and anything freely traded. This dynamic, the author claims, is why powerful players can potentially manipulate prices. Suppose I were one of these players aiming to profit from Bitcoin years ago when it was cheaper. What could I do? First, I'd aim to accumulate a significant portion of the available Bitcoin, consistently buying to reduce the floating supply. As supply tightens relative to demand, the price tends to rise. For example, if many were selling at $600, but my buying absorbs that supply, the next seller might demand $800, or $1, or more. The price might jump significantly to meet the next available ask price because the order book is thin between those levels. I can push the visible price up dramatically by clearing out lower sell orders without buying every single increment. I continue until I hold a dominant portion. If I then stop selling, supply dries up further. I have significant price control. Let's say the last trade was $1. Someone wants to buy, but only I am willing to sell. I could place a sell order much higher, say $10, to make this price real on the charts. I might even use another controlled account to buy a tiny amount from my selling account at $10, a wash trade, or painting the tape, often illegal in regulated markets. Result: charts show a jump from $1 to $10. On paper, my entire Bitcoin holding just multiplied in value, based on a potentially manipulative, small transaction, but it's just paper profit. To realize this gain, I need to sell my holdings to real buyers with real money. That's the ultimate goal, cashing out. However, when I start selling, dumping my large holdings, if there aren't enough real buyers at the high price, I'm stuck. Selling large amounts will crash the price. I might not make much profit, or even lose money if sentiment turns before I exit. Therefore, a crucial part is manipulating market psychology, leveraging FOMO, fear of missing out, greed, herd mentality, to ensure enough other investors, often small retail investors lured in by the rising price, are willing to buy my inflated Bitcoin. Think about the pandemic stimulus and rising asset prices. You saw headlines. Maybe your neighbor, Mrs. Mai, got rich quick investing in crypto. FOMO kicked in. You finally bought, often near the peak. You became the bag holder, providing exit liquidity for earlier players. The author cynically suggests this cycle repeats. You might think you only lost, on paper, but you absorbed the real loss, enabling the manipulator's plan. Now, back to the manipulator's exit problem. Even with buyers, selling a huge position crashes the spot price. How to lock in profits without doing that? This is where the derivatives market, futures, options, can be used. The author suggests 1 alleged strategy. Suppose I've manipulated the spot Bitcoin price to $10. Imagine the futures contract price, e.g. for 1 month delivery, is lagging. Say at $9, a large gap. Used for illustration, arbitrageurs will buy the cheaper futures and sell the expensive spot, or vice versa, quickly closing this gap. But as the futures price rises towards the spot price due to this activity, the manipulator holding spot Bitcoin, can sell futures contracts at these high prices, say $9.500 or $9.800. If I sell futures contracts equivalent to my spot Bitcoin holdings, I've hedged. My price is largely locked in. I can wait for expiration and deliver my spot Bitcoin at the agreed high futures price, exiting without crashing the spot market directly. Do you understand? Simply put, the alleged strategy involves manipulating the spot price higher, then using the derivatives market, selling futures contracts at inflated prices, to lock in gains and facilitate an exit. Many people have paid dearly, losing savings, without understanding where the money went. But the author stresses, your desire for a better financial future is valid. However, you need to realize that in freely traded markets, power dynamics matter. The strong can influence the game. You seem to have 2 options. Try to become strong yourself, difficult, or learn how to analyze and potentially follow the moves of the strong, also requires skill. Therefore, as I often emphasize, when starting with little capital, focus on building a solid income stream or career first. Rushing into high-risk investing with limited funds is dangerous. Small wins, potentially devastating losses. Using leverage or debt prematurely is highly risky. Ideally, build a business or income source that generates consistent cash flow. The pandemic highlighted the shift online. Online shopping, delivery, education thrived. In the internet age, businesses depend on traffic, attention. Whoever captures attention captures revenue. Platforms like YouTube, TikTok, Facebook offer massive reach. This is an opportunity. You can build a presence online, reaching more people than pass through Times Square, often without physical rent or large inventory. It's possible to generate significant, sustainable revenue online. Because time is limited, let's pause here for today. On this channel, I share free knowledge on becoming a successful entrepreneur and investor to achieve financial freedom. If you don't want to miss future content, please subscribe, turn on the notification bell, and consider sharing this video. My best wishes to everyone who liked this video. May you achieve financial freedom soon. If you found even 1 or 2 useful ideas in today's content that could help improve your perspective or life, then I feel satisfied.